Hey everyone, Ruben Colombe here with Colombe Credit Repair Services, and in this video we are going to explain revolving credit. Now, what exactly is revolving credit? So revolving credit is a credit line or your available credit limit on, say, a credit card that stays the same from month to month. Now, you can use as much or as little of this available balance as you would like. Every month you receive a bill that you need to pay for the used balance. And if the card, this is one thing to remember, if the card is not paid in full every month, what you're paying interest on is the remainder of the balance. So let's say you owe $300 and you pay $30 down, let's say that's the minimum. That means $270 is what you're paying interest on, not just that payment that you made. So you're paying interest on the remaining balance of $270. Now, some examples of revolving credit are obviously credit cards and home equity lines of credits. Now, the difference between revolving credit and installment loans. A revolving line of credit is like what I said before. It can be drawn from the original line from credit from month to month, from your available balance. Now, an installment loan is a fixed amount and it has a repayment term. That's such as a personal loan, car loan, home loan. So, you have a home loan that's $400,000. You have, 30-year mortgage that you pay on, you pay so much a month. It's not like the remaining balance that you have left that you can pull from. I think everyone understands that. So when explaining revolving credit, that's things such as credit cards, and installment loans are things such as home loans and car loans. So that's a simple way to remember it. Now, the biggest difference between the two come with interest rates. So basically with credit cards and revolving credit, there are much higher interest rates, and it's different from, company to company, card to card, and it's also based on your credit scores. And credit cards typically have an interest rate of 9 to 25%, which, if you have bad credit, obviously you're getting closer to that 25%, which can be a huge number when making minimum payments. That's why it's a good idea to make larger amounts to your payments. Now, installment loans are typically from 2 to 18%, again, based on your credit score and the bank, of course. Now, why use revolving credit over an installment loan? Revolving credit offers flexibility on spending from month to month. So, you can spend $10 on the available credit, or you can spend all of the available credit. Obviously, you don't want to spend it all because that has an effect on your credit scores, and that's another video that we will get into. Now, you can also get rewards with certain credit cards, and a lot of people use their credit cards smartly just for the rewards, and I'm actually going to do a video on that soon, talking about churning credit cards and making the most out of getting rewards for those. Now, when it comes to your credit score and revolving credit, any purchase on your card has an impact on your score. So if you're, using up the full balance, that's a negative impact on your score, because there is an average of how much available credit you have and how much you use, and the higher that average is, the lower your score is going to be. So that's why that magic number I tell people is keep your owed balance below 20% of the available credit. And that keeps you pretty safe. Even if you max out the card and pay it all off every month, that doesn't necessarily mean that's going to help, because it may report to the credit bureaus at that max amount, that full balance. So it's a good idea just to keep that below the 20%, and that'll help your scores grow from month to month. So basically, how you handle that revolving credit has a huge impact on your scores. Like I said, with the balances, keep them low, and obviously on-time payments. Missing a payment, having a 30-day late has a huge impact on your score, and it takes a long time to come back from that. There's going to be a video where I also explain how late payments, 90 days, 30 days, 60 days, how long it takes for those to not affect your credit scores as negatively. So that's basically revolving credit and a breakdown of that. I will also be doing a video on installment loans, explaining those in more detail. So I hope this information was helpful to you. If you enjoyed the video, hit like, follow my Facebook page at Colombe CRS. And if you have any questions, feel free to message me or email me, or if you're interested in credit repair, send me an email or you can message me and I'll get back to you as soon as possible. So everyone, you have a great day and thank you for joining me.